Hey Finance fam, welcome back to my channel. In today's video, I'm going to talk through 4 reasons why you should not invest in a target date fund. I'll start this video by saying there's absolutely a time and a place for a target date fund. And if you don't know what a target date fund is, generally it's investing in stocks and bonds, and it's basically rebalancing the portfolio allocation for you automatically as you approach into a specific target date. So you'll see target date funds in retirement for 2040, 2050, and beyond. So what a target date fund does is it invests in stocks and bonds, and it sells stocks and buys more bonds the closer you get to retirement, or AKA the target date. A lot of people love this idea because they don't really have to huss and fuss with their portfolio. They can put money in a target date fund. It'll rebalance on its own at the right time, and they can just cruise into retirement. So the first reason why you should not maybe invest in a target date fund is that target date funds are one risk tolerance fits all strategies. So one size fits all in terms of risk tolerance. It doesn't matter if you have an aggressive risk tolerance or a conservative risk tolerance, you're getting one portfolio allocation. These are not tailored allocations. They're very heavy in stocks for many years, and then as you get closer to retirement, it starts to taper from stocks to bonds, putting bonds in the portfolio or more bonds in the portfolio. So, that may not fit with your risk tolerance. Maybe you don't want to be too aggressive in stocks. Maybe you'd rather have like a 60-40 portfolio, even right now, even way before retirement. So if you're more of a conservative investor, this may be a little bit jaw-dropping when you go through the corrections that the stock market can have, meaning the sell-offs and the bear markets that the stock market can have. If you're only in target date funds, you're going to likely be heavier in stocks, and you're going to have more volatility in your portfolio. So just something to be aware of. I'm not saying that can't work, but I am saying that it may not fit your risk tolerance, and you may be a little more on edge when those bear markets or those sell-offs do come if you're in more stocks than bonds. The second reason you may not want to invest in a target date fund is it doesn't really diversify you across multiple asset classes. It definitely gets you exposure to the two majors, which are stocks and bonds. But if there are other things that you want to add into your portfolio, or even other strategies like other styles of investing, like dividend investing or investing in real estate investment trusts, aka REITs, you won't really have that option. You'll have to add that stuff in addition to your target date fund, which is not that big of a deal. But if you're looking for a one and done solution with a target date fund, it might not be giving you all the exposure that you're looking for to different types of asset classes and even different types of investing strategies. So definitely something to keep in mind if you're wanting to add more than just stocks and bonds into your portfolio. But of course, stocks and bonds are the majors, so that's definitely a plus. The third reason you may not want to invest in a target date fund is because it doesn't really give you a lot of control over your selling strategy. So whenever we get close to retirement or we're in retirement, we like to kind of have some levers to pull in terms of what assets we can sell, depending on what the stock market and the bond market and other markets are doing. And so there might be times in retirement or close approaching retirement where maybe you have a lot of gains in your stocks and you kind of want to shed those off and take some of those gains and redistribute that cash elsewhere, depending on where you are in retirement, and if you need to invest in some more bonds or have some more liquid cash, right? So if the stock market's doing well or the bond market's doing well or vice versa, you want to kind of have a little bit of control over where you're pulling cash from and where you're selling from to make sure you're the most efficient. You have the most efficient strategy in retirement and through retirement. So target date funds, you kind of just have to sell the whole thing. You can't pick and choose by selling some stocks and bonds. You have to sell the whole entire target date fund, which is essentially going to be selling both stocks and bonds, right? Because it's a one wrapped fund with both inside of it. So by having a target date fund, you maybe don't have as much control over the selling strategy strategy that could help you be super efficient and make sure that you're taking gains and maybe redistributing assets accordingly and very strategically. A good example of this has been kind of recently, like starting in 2020, we saw massive gains in stocks, and a lot of people wanted to harvest those gains. And then after that, we saw huge declines in bonds. So you would maybe want to take advantage of some tax loss harvesting in bonds after we saw that big decline. So in short, it's a benefit to be able to sell specific asset classes at different times depending on performance of that asset. And when they're grouped together in a target date fund, it definitely makes it a little more difficult. The fourth reason why you may not want to invest in a target date fund is because the glide path, aka the path that the target date fund is selling stocks and buying more bonds, may not actually fit your goals in your retirement plan. So the target date fund doesn't care about how your other assets have performed or how your retirement is starting to shake up, and it really doesn't care. So one of the problems with target date funds is when you are going into retirement and going into that target date, you're just stuck in terms of that target date fund doing whatever it's going to do in terms of moving out of stocks and into bonds closer to that date, right? But what if you were in a situation where you didn't really need the money in that target date fund closer to retirement because other things happened? Maybe you ended up getting access to a pension. Maybe your assets in other accounts grew more than you expected. And you kind of can let that target date fund ride the markets a little longer, right, into retirement. Well, you don't get that option. The target date fund is going to switch over from stocks to bonds when it gets close to that target date. So it's kind of nice to have that control and flexibility, especially once your retirement picture becomes more clear. Say maybe you're 5 years off for retirement, 3 years, 2 years off from retirement, you're going to have a lot more clarity into what you're going to be needing to survive and pay your bills and what accounts you're going to want to pull from based on taxes in that time period. So the glide path may not fit with those goals, and you're going to end up moving more into bonds as you get close to that target date when maybe you don't need to in that moment with that capital. So who should buy a target date fund? I think that target date funds are good for people who are very hands off and, maybe they have very simple situations and they don't want to overcomplicate things or get overwhelmed or confused. If that's the case, then a target date fund is going to be way better than not investing at all, right? Because you feel overwhelmed or unsure. So target date funds are just really well packaged, do it yourself solutions that you really don't have to do a whole lot of thinking or rebalancing with. So that is who a target date fund is good for. But if you want to get more strategic and as you gain more capital, if you have a lot of assets, target date funds might not really fit the bill for all of your capital. For some of your capital, sure. Some people in a 401k, they don't have a choice. They have to invest in a target date fund, and that's fine. But for those that have the optionality and a lot of assets, you really want to start thinking about how you're going to strategize taxes and making sure that you have the right accounts and the right assets in those accounts, because that's very important. It's called tax location. Some types of retirement accounts are actually better in terms of tax location strategies. Certain types of retirement accounts, like Roth accounts, do really well with high expected growth assets like equities, for example, aka stocks. So, stocks may be better in the Roth account, and then bonds may be better in a traditional account. So, you're not dealing with the taxation that you would have to deal with in a taxable account. So, there are different things that you can do, and it's nice to be able to put assets in different types of retirement accounts for tax location strategies and efficiency with taxes. So again, you can't really do that with a target date fund. It's all kind of going to the same place. So what can you do if you're forced to invest in target date funds for retirement because of your plan at work, but you don't really know if you want to? And in that case, what you can do is just make sure that you have other capital that you're investing elsewhere in other types of accounts, in other types of assets, the way that you want to. So it's not all a loss here. You can just allocate to the target date fund whatever it is that you're wanting to. And then on the outside of that, you can make sure that you're investing elsewhere in the best assets for your situation. All right, to recap the 4 reasons why you might not want to own a target date fund. 1, it's one size fits all in terms of risk tolerance. It doesn't matter if you're a conservative risk taker or an aggressive risk taker, a target date fund is going to just have one strategy, one allocation, glide path, and you're kind of having to have that whatever your risk tolerance may be. 2, it may not diversify you enough across asset classes, and maybe that's okay with you, but typically target date funds are only investing in stocks and bonds. So if you want access to real estate, or if you want access to crypto or commodities or anything else, you're probably going to have to invest elsewhere for those asset classes. Not only that, it might not diversify you across the specific strategies that you're wanting to use. Say you really like dividend stocks, or say you want to invest in certain themes like technology or real estate. It might not diversify you across the strategies that you're looking to be invested in. 3, you have less control over what assets you can sell while you're approaching retirement or in retirement. Again, when the stock market's up and the bond market's up, or vice versa, it's nice to be able to pull specifically from those assets without having to touch another. So you may want to pull from your stocks without touching your bonds, or vice versa. And the target date fund doesn't really allow you to do that. It's one fund you have to sell when you sell everything. You have to sell stocks and bonds. And 4th, the glide path, which means the path that it takes to sell your stocks and buy more bonds going into retirement, it may not actually fit your goals. It may not fit your lifestyle. It may not fit your needs. And it's possible that even though you're going into that target date with a lot more bonds, you may not actually need all those bonds. You may possibly have the ability to stay invested in stocks a little bit longer than you anticipated due to the way retirement is shaping up for you as you age and as things change in your life, right? All right, Finance Fam, do you have questions? Post them in the comments below. If you like this video, if you learned something new, if it helped you out, go ahead and click the like button, subscribe to my channel if you're not subscribed. I teach you how to be a better do-it-yourself investor, and I teach you how to save on taxes too. Love that. All right, I'll see you next time.